Welcome to Before the Bell, your home for actionable pre-market content. Good morning, traders. This is Chris Buss with Traders Profit Compass with your morning look at markets for Tuesday, February 22nd. It is 7 a.m. straight up as I'm starting the video. Over the weekend we had, of course, a lot of headlines in the Ukraine. Futures took a deep dive and they have since rallied this morning, bringing a lot of those averages back up to flat. Let me run through the futures with you. And of course, don't forget to run the video at 1.5x. Oil's up 3%, of course, on the Ukraine stuff. Bitcoin is down 6%, losing that key $40,000 support level. Large caps and small caps are largely flat. NQ is down about 0.5%. Gold is flat. Over on the macro front today, not a lot. Case-Shiller, we've got housing prices, consumer confidence, and a 2-year bond auction at 1 p.m. On the earnings front, we've got Home Depot, TJX, Macy's, and Cracker Barrel before the bell. In fact, I heard Home Depot reported a good number and was up on that. After the bell, we've got Mosaic in the fertilizer space, Teladoc, Palo Alto in the cybersecurity space, and Caesars Entertainment in the gambling space. So if you've got a pencil handy, I want you to write down some numbers. What I like to do, especially when there's volatility before the bell, is to mark the pre-market low. Actually, the pre-market low and high, but since we're at the high of the range, I'm just going to let that one go and let you mark that yourself before the open. But here's what I have as lows for the indexes. For SPY, 425.90. For the Qs, 332.25, and for IWM 195.50. And the reason I make mention of that, the market has a funny way of finding those pre-market lows and pre-market highs during the regular session. Now that doesn't mean that we're going to go down and tag those lows, this afternoon or sometime today. But during the regular session, whether it be today, tomorrow, Thursday, whenever, the market likes to go down and revalidate those pre-market levels. And so that should be something you should incorporate into your narrative in the next few days. And also I make mention on the blog site that we should expect heightened volatility. I mean, it's almost a given with the headlines, but also don't forget that February OPEX rolled off on Friday, so that naturally will open up the option chain for traders to reposition their bets and their hedges going in, towards March, where of course we have the roll off of QE. That's going to stop in a couple weeks. And also we've got a FOMC meeting that has been the topic of debate, on whether they're going to hike rates 25 or 50 basis points. So there's that opportunity this week for the indexes to find new levels of equilibrium. So keep that in mind. Now I'm going to run through these charts. Just keep in mind that, as soon as I publish this thing, they could be instantly wrong with the volatility that's going on. But I think it'll give you a good idea of where we're at and some of the levels and considerations for trading. So starting out on the SPY daily, I think your pivot point is right here at 432.50. And the key overhead resistance in my mind remains the 200-day, which comes in at, let's call it 438. So as long as price remains below the 200, you're going to have a bearish tilt to the charts. And don't forget also that regardless of this pre-market bounce, it hasn't changed the weekly charts that we reviewed yesterday. And if you're new to the channel or didn't happen to see it, go back and look at the video that I posted yesterday on the weekly charts of the indexes and FATMAAN names, because as we discussed, weekly signals trump daily signals. So as long as those weekly charts remain below the 40-week moving average, they have a bearish tilt to them, and the market will remain, technically vulnerable as long as that's the case. So keep those longer term time frames in mind, even though you may be, trading a rally this morning or whenever, keeping in mind if you've got a bearish signal on a weekly chart, that bullish rally on the daily chart will by definition be a counter trend bounce rather than, quote, a new uptrend. So keep that in mind, that the weekly charts are still in place. Here you've got some resolution on the 2-hour chart, and you can see that I mentioned the pre-market low was down here at around 425, which lines up with the closing candle levels here on the January low. Now you see the tail here also that dips down to the 421 area, so that is also a level that I want you to keep in mind should things roll over. But this 432.50 should suffice this morning. Don't forget we've got downtrend lines as resistance, and that it's not a coincidence that comes right in at 438 where the 200 is. So if we were to get a rally into 438 at the 200 and at this downtrend resistance, that's a very objective place to say, okay, let's see how price handles the 200, and it would be an objective level to try a short with a stop just above, and then your decision tree should be if price can break above the 200 and hold it, so break out here above the downtrend line at 438, then you can reorient to say, okay, we've recaptured the 200, and near term, that's a very bullish technical event. So there's a good chance today that price will make a run at that 438, and then we'll have to see how price handles it at that time. Now, you can see here on the Qs, we finished Friday right near these January low levels at 340, and I told you that the pre-market low was down here where this long tail was, down towards 332.50. So that is your, if we were to break 340, my first inclination would be it's going to come down and revalidate those lows. Now on the bullish side of things, we've got a pretty steep downtrend here that will be first resistance on a bounce up into 350. But look, you've got the declining 8-day, 20-day, and then you've got the 200 way up here at approximately 362, and you've got a gap in between. So there's a lot of work to do on the Qs to get this to get the Qs back in a bullish posture. So my default position on the Qs until further notice is to fade the rips. When you see price come into solid resistance areas, be it a downtrend line or lateral resistance, where you see price stall or fade, that's a place where you want to re-engage your short position with a stop just above. And you notice here on the Q daily, you've got a large volume over price bar here that comes right in at 350. I would imagine, unless things dramatically change, that any bounce into 350 is gonna fail. Here again on the zoom in on the 2 hour, you see we tagged that January low levels and bounced a little bit, and then we had that big fade at the end of the day. You can see that better here on the 30-minute chart. We came down, tagged that low, and then bounced up to 345 and then failed. So there you have some real objective levels to shoot against, whether it be on a rally this morning or if they begin fading this pre-market move right off the bat. IWM, as you'll recall from yesterday's video, remains the most bearish of the three indexes. Why? Because we dropped out of this big consolidation range. We had a breakdown and a back test of that range, and now we've dropped below this bear flag look. I think the first, and I think we're there. No, we're trading around 199 pre-market. So although we dipped down towards 195 over the weekend in futures, we've rallied up, but are still below this 202.50 area, which I think would be resistance. Here you've got, I've got a pivot point here on the 2 hour around 200. I would think that bounces into 202, 203 are going to be tough sledding, and I would be motivated to re-engage shorts on any big sizable bounce into resistance, keeping in mind we do have an open gap up here to 206 that we had from last week. Here's just some resolution on the 30-minute chart. If you're new to the channel here, I want to welcome you. Really appreciate you spending some time with me and the gang this morning. If you appreciate technical analysis and you think it would benefit you to have a pre-market look each and every day that gives you objective levels to trade against, please hit the subscribe button and the alarm bell. Hit that post notification content so that every time I post a YouTube video, you'll get notified of it. And also jump over in the show notes. You'll find a link to the blog site where you can drop in your email, and then anytime I publish market commentary, you'll get it directly in your email box. You won't have to look for it. And very often during the day or even after hours, I'll send out short market observations or midday video or trade idea, something like that. And you'll get that right in your email box if you do that. So, okay, moving on to Facebook. Very bearish setup, coming in here to a level at 200. Like I said before, I would see how it handles 200. If there's a rally this morning, so be it. But I think 200 is going to be your next big pivot point. And if the market, rolls over in general, I'm sure Facebook will dribble lower right along with the market and below 200, I think it can fall down towards 180 probably pretty quickly. Apple has held up really, really well during this downdraft. We had a sharp move down, then a rally, then back down to these lows, which held on Friday right here at 167. To me, that's going to be your pivot point. But the problem is now you've got quite a bit of overhead resistance. We've got a band here, and these levels have worked really, really well. You've got a band here from about 168.50 to 170, and then you've got another band of resistance that runs from 172 to 173.50. So that's what Apple faces. Now on the downside, if we were to lose 167, I think you could be short there and look for a move down to 165.50 for starters, but then a bigger move down to test this gap that starts at 163. So that 167 level is going to be really, really important for Apple. Tesla, I've made a note here that the 200 EMA comes in at 861. I think this is a real pivotal level for Tesla, just by the simple fact is that it's wrestling with the 200, and whichever way it resolves will be rather important. If it can break above the 200 and hold it, then the bulls have a chance to rally it up above 880 and then make another run at this 905 and then potentially 935. On the flip side of that, if it gets rejected at the 200, I see it coming down to 830 and 800, and then you can go out on the daily chart or even the weekly chart if things start to fall apart on lower levels if in fact price loses the 200. Microsoft has been really weak. We had a breakdown, a bear flag, second leg down. We came down and filled this gap down to 288, where price was able to hold it on Friday. So as far as Microsoft goes, 288 is your pivot. You'll have resistance at 290. Then you'll have resistance at like 293.50. If it were to lose 288 at any point in the future, I think you're going to come down to this 282 level on Microsoft as first support. Amazon, we had a move down, pretty good rally to back test this old level, and then it let go again. I think right here at, let's call it 30.45, I think is your pivot. On the upside, you'll have resistance at 3100 and then 3150. On the downside, back towards 2980, 2985, and then right on down. So some pretty clear levels for you to shoot against on Amazon. And I keep reminding people that XLY is 25% composed of Amazon. And also, now that I think of it, XLC, the communications sector on your Spider ETFs, is comprised of nearly 50% of Facebook, Google, and Netflix. So if you wanted to put on a long or a short, and those options are just too expensive or volatile for you to comfortably trade, as you're sizing up, Facebook, Google, Netflix, if you're bearish on those, you can play XLC as a proxy, and I guarantee you, if you're right on Facebook, Google, and Netflix, that you're going to be right on XLC, as those are the three most dominant issues in that particular sector-weighted ETF. So moving on to Google, pretty steep slide from that big gap up we had on earnings back in February. That has all since been faded, and now we're down here at around 26.10. So that's going to be your pivot point going forward. You've got a level at 26.60 and 26.80 at this large volume over price bar. So that would be a big level to overcome here at 26.80. And you'll also see you've got, prior lows in here and technical resistance across that line. That will certainly be a good test for Google on the upside. And then on the downside, you've got these lows back in January that haven't been tested yet. So my expectation would be on a breakdown, eventually make its way down towards this 25.10 area. Netflix, after the big gap down, we had a rally, and now we've settled into a pretty narrow trading range between 387.50 and 407.50. I suppose you can try to trade that, inside the box. Pretty narrow, as far as, being able to grab those expensive options. I would rather, my personal choice is rather wait for a break outside of the box for a more clear and probably swifter type move. So if you agree with me that that's how you want to trade it, set yourself an alarm at 387.50 for the downside and 407.50 or 410 on the upside, and just trade it like a bracket trade where you follow price out higher or lower from the range, depending on which way it goes. And I think you'll have a higher probability chance of getting, a run or something that moves relatively quickly. Moving on to semis, we had a low here just last week. We gapped up, made a couple runs here at 280, and has since rolled an over to validate this prior low again. We had the rally on Friday and then a pullback move into the close. So I think this 266 area is going to be your pivot, and then your first resistance is going to come at 270 back at the top of the old gap, and then you've got a level at 262, which are the prior lows. If we were to break 262 to the downside, I think it's going to be a fast move towards 256 down here, and then potentially back to these January lows back here around 250. But first things first, as long as it holds 266, the bulls have a chance to rally it here, move it up above 270, and then up towards 273. Now I want to wrap up with the ARC names that we've been focused on as far as representing the Ponzi bubble stocks with, stocks with big hopes and dreams and a fantastic story, but not a lot of profits to go with it. Big negative PEs or ridiculous PEs, however you want to look at it. The ARC financials right here, I think you've got a pivot point at 29.50. As long as it stays below that, I think it's going to come down here towards 28 at these prior lows. If price breaks above, then it could potentially rally up to 31. ARC Genomics, you've got a clear pivot at 45. Any break below, I think you find 43 very quickly at these prior lows. As long as it holds it, you could see a rally back up to 47.50. Flagship fund, this is the one with a lot of Tesla in it, has already reached the prior lows back here at 65. I think it's pretty clear it's got to hold 65 or, bad things happen. So if you're interested, and you didn't want to trade Tesla directly just because of the price of the options or whatever, ARK is the ARK-K is pretty much going to go in the direction of Tesla. I'm not sure what her exact percentages of Tesla. You could go to any one of the ETF websites, and if you want to look at the individual components of ARK-K, you can do that and find out, is Tesla 10% or 12%, whatever it is. But in general, I think it's safe to use ARK-K as a proxy for Tesla. Really critical spot here, 65 on ARK-K. ARK-W, the web, it too is down here at the prior lows at 82. Any kind of break at 82, and it starts the next leg down. As long as it can hold 82, it's got a chance to rally up towards, I'd say like 87 as a first stop. I don't have it marked in here, but you can see there's a prior low right here at 86, 87, where it would encounter the first bit of resistance. So let's go over things really quickly. We've got February OPEX that is rolled off. That's going to allow the market to find new levels of equilibrium as traders lay on hedges and their new positions, building those call and put walls that we talk about occasionally, which tend to range bound price in those areas. We've got the headline risk of the Ukraine thing. Very hard to trade, very hard. I mean, you'll see it in the chart way before you can find it on Twitter. So my advice there is don't even worry about it. As far as a something that's tradable, I think you just got to go level to level. And then we've got the larger backdrop of a regime change in the Fed going from QE to a monetary tightening regime, whether that ends up being QT, where they let the balance sheet roll off without replacing it, or simply ratcheting up rates to fight inflation. The result is the same, a draining pool of liquidity where makes it difficult difficult environment for stocks. And then don't forget those weekly charts that we reviewed. You can go through and set the alarms, where those weekly charts would again look bullish. And then that way, when you get that alarm, you can be a little bit more secure in taking longs on stocks for a renewed uptrend if those weekly charts can turn around. But until they do, we've got a bearish backdrop regardless of this, sizable bounce that we've got here this morning. And don't forget to mark those pre-market lows. I'll go through them again for you. SPY 425.50, Qs 332.25, and IWM 195.50. Make sure that's a bold line on your charts that you can mark as a pre-market or over weekend lows on those indexes. And then if things do roll over, that'll be a big line of demarcation. If it simply comes down to double check that level and then holds, that'll be incrementally bullish. But if those pre-market lows do not hold, that will usher in most likely another bout of selling. So, all right, stay on your toes today. I hope you found the information helpful. Remember, no dart throws. Stay really, really objective. Honor your stops. That's the only way you can ensure that you don't get, monetarily really hurt. Just reset, take your paper cut, and look for the next opportunity. Don't sit there and try to prove the market wrong by staying in a losing position. Quickly get out of it and then reset at another level. And stay on your toes. Stay on your toes. This market is moving really fast, and if you find that's an environment that you're just not comfortable in, no shame in just stepping away until price finds a level that you're comfortable going either long or short. And because there's going to be a lot of whipsaws, and if you're not prepared or don't want to trade them, then don't. That's the best policy. Wait for your fat pitch, whatever you think is in your wheelhouse. I would steer you to continue to do what you have found to be best for you. But hopefully the levels will help you. So have a good day of trading. This has been Chris Buss with Trader's Profit Compass. Talk to you next time.